are again. We are still in Chapter 9. We will probably finish lecturing in Chapter 9 today, but I know I assigned probably about 4 or 5 homework questions and exercises, didn't I? So let's go ahead and dive into those. Let's do Quick Study 9-2. Now, let me do a little refresher that we did last time, but it's so important that I want to go through it again because students always seem to get this confused. Under the allowance method, there are times that we will estimate bad debt expense. That's like using the percentage of the sales, the percentage of the receivable methods. When we do that, what we debit is bad debt expense, and we credit allowance for doubtful accounts. That's when we estimate bad debt expense under the allowance method. Okay? Now, there will also be times that we write off a specific account. We know a specific customer who's not going to make good on their receivable. When that is the case, under the allowance method, when we write off a specific account, we debit allowance and we credit AR. Okay? So in this situation on Quick Study 9-2, they're asking us to write off a specific account. It says, Corda's company uses the allowance method to account for their uncollectibles. On October 31, it wrote off a $750 account of a customer, D. Elwick. On December 9th, it actually received some payment on that. But let's do the write-off first. It says, prepare the journal entry or entries for October 31st when we write that baby off. Okay? Well, when that is the situation, the journal entry we make is right there at the top of the screen. Okay? We debit allowance for doubtful accounts, and we credit accounts receivable, D. Elwick. Now, I'll tell you this. When I ask this on a test, everybody just feels like they got to debit bad debt expense. When they write off an account, they go, oh, I got to debit bad debt expense. There's no debiting of bad debt expense here, is there? Okay? There's no debiting of bad debt expense. We've already debited bad debt expense back when we made our estimate. Now, on December 9th, this guy strolls in, and we get a $400 payment, don't we? Okay? So what do? Well, this is the entry we make at first. We reverse $400 of that entry that we just made, and then we show our collection. Okay? Now, if there's a strong belief, as it says up there, that you're going to be able to get the other $350 as well, then in this entry right here, you'd actually reverse the whole thing, and that would be for $750. Okay? But if we think we're just going to get $400, the entry would just be a debit to AR for $400 and a credit to an allowance. Okay? All right? Now, one student asked me once, why do we make these two entries here? Here we debit the receivable, and then we immediately credit the receivable. Couldn't you just combine those two entries and debit cash and credit allowance? And I said, no, not really. We don't want to do it that way. Do you know why we want to do it this way? The reason we do it this way is this shows the activity in that customer's accounts receivable detail. If we did it the other way, there'd never be any record in that T account of that customer's account that this occurred. Does that make sense? So this gives us a record. Okay? All right, any questions on that? If not, let's hop over to, I believe, exercise 9-3. Was that the next one? Okay. Now, I cannot stress this enough. These sort of questions will be on the test, okay? There's always some students who have trouble doing these, okay? Or they get mixed up when you have to analyze the T account and when you don't have to analyze the T account, okay? In exercise 9-3, we're going to use the percentage of sales method, so we don't have to analyze the T account, do we? Okay? All right, at year end, December 31, Turner Company estimates its bad debts as 0.6% of its annual credit sales of $858,000. Turner records its bad debt expense for that estimate. Okay? All right, let's go ahead and make that journal entry first. See what that one would look like. Okay? Well, here we just take the 0.006. That's how we would punch 0.6% in. We take 0.006 times the credit sales of 858,000, and we get an amount of 5148. And boom, that goes right in the journal entry, doesn't it? We don't have to analyze the T account. It's a percentage of sales method. Okay? So that is the journal entry that we make there, right? Okay? It goes on to say, on the following February the 1st, Turner decides that the 429 account of D. Fidel is uncollectible and writes it off as a bad debt. Okay? All right, now we're writing something off, correct? So what's the entry when we write something off? It's the debit to allowance, the credit to AR, correct? And there it is. Once again, this entry is estimating bad debt expense. Those are the accounts that are debited and credited. And in this entry, we are writing off an account. And please note the accounts that are debited and credited there. I'll ask you to do both on the test. Okay? Now then it goes on to say on June 5th, they pay the amount previously written off. So all we do is we reverse that entry that we just made, and then we show the cash collection. You guys getting these? Questions? All right. Let's go on to exercise 9.4. All right. Exercise 9.4. And this is going to be a percentage of AR method. At each calendar year end, Rivka Supply Company uses the percentage of AR method to estimate bad debts. On December 31 of 2009, it has outstanding AR of $139,500, and it estimates that 2% will be uncollectible. Prepare the adjusting entry to record bad debt expense for the year 2009 under the assumption that the allowance for doubtful accounts has a $23.71 credit balance before the adjustment. Okay? All right, let's do that. Well, here is the answer. Let me go ahead and work through how we did that. Okay, we're going to take 2% times our AR of, how much is AR? $139,500, is that correct? And that equals what? $27.90? Is that the amount that goes in the entry? No. That is the amount that we want to be the ending balance of our allowance account. But we have a beginning balance of what? 2371. So the entry that we have to make is for 419. Okay? Let me zoom in a little bit. Whoa, wrong way there. Okay? Make sense? Now in the next situation it says, what if instead we had a 487 debit balance before the adjustment? Okay? Well, this would be our entry here. In this sort of situation, we still want an ending balance of 2790, which is 2% of our AR, okay? But we have a beginning balance of 487 to the debit. So what do we have to do to bring a 487 debit balance and allowance to a desired credit balance of 2790? We have to credit it for 3277. Okay? And that's the amount that goes in there. Cool? We've done a ton of these, it seems like, haven't we? And what's the best way to study for a test? get a blank piece of paper out, see if you can do the homework. Okay? All right, questions on that? I think I signed some more, didn't I? Let's go on to, was it exercise 910? 13? Is that the last one? Okay, I thought there was one more, maybe not. Okie doke. Okay, this is on accounts receivable turnover. Okay? Now this goes to the reading that I wanted you to do in your book. Okay? Now, this is accounts receivable turnover is a measure of both the quality of the receivable, which is the likelihood that we're going to actually collect the money that's due, as well as the liquidity, which is how fast we're going to receive it. Okay? We get AR turnover by taking net sales over our average accounts receivable. Okay? And exercise 913 has us calculate this and interpret this. Okay? Exercise 913, top of page 381. The following info is from the annual financial statements of Lucilla Company. Compute its AR turnover for 08 and 09. Compare the two-year results and give a possibility for any explanation for the change. Okay? And it tells us the competitors average a turnover of 7. Okay. First of all, let's just look at the computation of these. Okay? Again, we take the sales divided by the average AR. Okay? Now, first of all, did you get those numbers? You got to be careful when you punch this into your calculator. Sometimes people will say, I had this set up in my notes just like this, but when I put it into my calculator, I got a different answer. And that's usually because they did something like 193,000 minus 37,200. I'm sorry, 193,000 divided by 37,200 plus 4,500 divided by 2. And you have a problem with your order of operations there. Okay? So make sure that you are punching that into your calculator correct, following the appropriate mathematical order of operations. Okay? Now in 08, our turnover was 5.0, and in 09, it went up to 6.3. Okay? Now, what are some... First of all, is that better or is that worse than our competitors? Again, do we want it to be high? Do we want it to be low? Is this better or worse than our competitors? It's worse. Okay, take a look at it on the screen again. Okay. Now it has improved from 08 to 09. Now again, this is kind of a measure of how quickly your receivables are coming in. They are coming in quicker than they did, right? In 09, they are coming in quicker. Now, what may be some reasons that they're coming in quicker?
There's more of them.
Pardon?
There's more of them.
Well, I don't know if it's so much that there's more of them. Why would they be coming in quicker?
More incentives?
Perhaps you've changed your incentive. Perhaps you have, maybe you used to have just a pay by the end of the month. Now you have a 210 net end of month policy, or you have some incentive for them to pay early. Maybe you just have a new AR clerk and he or she is a real stickler.
What about
And they're on the horn more as far as getting these receivables in. So
types of payment? Like maybe you were only doing like checks, and now you open it up to credit cards, debit cards.
yeah, that could be. Maybe there's new methods of cash payment that you're now accepting. Okay? So it could be for a number of reasons. Okay? But for whatever reason, those receivables are coming in quicker. Now, we have to be careful here. Okay? Remember, the goal of the company is not to have whoever has the best AR turnover. Because I could make my AR turnover even higher and improved by just unbelievably tightening my credit policy. What if I just said, you owe the full amount in 5 days, or otherwise we're going to charge you 20% interest. Well, that might work for a little while, and then what are the customers going to do? They're going to go somewhere else. Okay. So the AR turnover is kind of a interesting little character here, because you have to analyze it. It can be too low and it can be too high. Okay. Again, if you don't like to wait for accounts receivable, you could just make all your customers pay cash, but you'll go out of business probably. Okay. So you got to be a little careful, and maybe see what, this is why I think it's a good one to analyze what your competitors are doing. Okay. All right. Questions? I think that's it for the homework, is it not? Okay, I want to talk about something real important that we didn't get. A couple things here today that we started talking about last time, and I want to emphasize something that's kind of interesting. Okay. Now, we talked about writing off a specific account, correct? Writing off a specific account under the allowance method. Okay. And the entry to do that is on the screen. Okay. We debit allowance for doubtful accounts and we credit AR. Okay. Now let's say, okay, actually before we do that, let's have a little refresher. Accounts receivable is an asset and it has a debit balance, right? Thus you increase it with the debit. Allowance for doubtful accounts is a what? What's allowance for doubtful accounts? It's a contra asset, and it has a credit balance. Thus, we increase it with a credit. Okay? So let's say we have the situation here on the Elmo. And this is a good reminder, too, of as far as how this looks on the balance sheet. And before this company wrote off a specific account that we're going to talk about here in a second, we had AR of $25,000 less your allowance for doubtful accounts of $1,000 equals your net AR of $24,000. Now, I like to ask this on a test. How does allowance for doubtful accounts appear on the balance sheet? Okay, and this would be the answer. Now, let's say that we wrote off a specific account. Let's say we wrote off an account for $100. Okay? So our entry there would be allowance for doubtful accounts, 100. AR, credit for 100. Okay? All right, so we would post this. Okay. Now, AR is getting credited, correct? So we are reducing it, is that right? So after the write-off, AR would be $24,900. Is that correct? We are also debiting allowance for doubtful accounts. Allowance for doubtful accounts is a credit balance account. So we're reducing our allowance, aren't we? So our allowance was $1,000. Now what is it? Now it's $900. So what is our new net AR? It's still $24,000, right? Our net AR didn't change. Yes, we reduced AR, but we also reduced the allowance that's being subtracted from AR. So when you write off a specific account under the allowance method, it actually does not change your net accounts receivable. All you're doing is saying, okay, we've got this allowance account for some accounts that aren't going to pay. Now we know a specific customer who that pertains to. Okay? And when we wrote this off, that had to do with a specific company, XYZ company or something. And of course, we have to go to their subsidiary detail and post that as well. Are you tracking with me? Does that make sense? All right. All right, we have one last subject to talk about in this chapter. And let's do that right now, okay? Let me bring these up. The last thing that we're going to talk about that is in this receivables chapter has to do with notes receivable. Okay? Notes receivable. Now, do you know what the difference? Let's do a little refresher. We talked about this at the beginning of the semester. What's the difference between an account receivable and a note receivable? Right. Note receivable has interest attached to it, and it's written down. It's a little bit more formal. Okay? So let's take a look at the PowerPoint. Let's take a look at notes receivable. Okay? A note receivable is a written promise to pay a specific amount at a future date, at a specific future date. Now, what it might look like is something like this. 90 days after date, I promise to pay to the order of Barton Company $1,000. I'll pay it at that bank. The interest rate is 12% per annum. That means per year. And it's due August 8 of 07. And this note was written up there at July 2007. Okay? So we have the terms of the note. We have the payee. We have the maker of the note. The maker of the note is the person who has to pay eventually. The person that is going to have to disperse the cash to the payee. We also have the principal amount, which is $1,000. We have the annual interest rate. We have the due date. Okay? Now, we have to figure up, going back to this slide, once October 8, 07 comes, then Julia Brown has to pay Barton Company not just the $1,000 principal, but some interest as well, correct? How much interest does she have to pay? Well, you're going to take the principal of the note times the annual interest rate, but here's something that is often forgotten. You have to take the time expressed in years. Okay? Let's look at an example. I think this will clarify. On March 1 of 07, Matrix Inc. purchased a copier for $12,000 from Office Supplies. Matrix gave Office Supplies a 9% note due in 90 days and payment for copier. Okay. So, in 90 days, Matrix Inc. has to pay $12,000, but they also have to pay some interest. How much interest do they have to pay? Well, you take the principal of the note, which is $12,000. Where's my pointer? $12,000 times the annual interest rate of 9%. But here, whoops, I kind of scribbled on that a little bit. You have to take it 90 divided by 360. Now, we could do 365, but a lot of times we'll use 360 because it gives us a little cleaner number. Okay? But 90 divided by 360, we have to do that because the interest rate of 9% is an annual rate. And we're only dealing in 90 days, right? Does that make sense? So, the total interest that is due is the $270. Okay? So how would that journal entry look? Let's see if they tell us. Well, when we buy the goods, when we sell the goods, we're talking from the seller's point because it's a receivable, it would look like the March 1 entry. When we received the cash at $12,270, $12,000 of that is for the principal, and the other $270 we record as interest revenue, calculated as we did in the former slide. Does that make sense? All right. Now, what about a dishonored note? This is when they inform us that they're not going to be able to pay it. Well, in that case, if they weren't going to pay it, we wouldn't debit cash. Instead, we would have to debit accounts receivable from this company. We'd have to set them up a receivable again. Okay? We'd have to set them up a receivable. And that's if it's dishonored. Now, We also, if you think back to chapter 3 when we did our adjusting journal entries, there was a journal entry, I think it was the 5th AJE we learned, or maybe the 4th one, I think, 4th one, accrued revenue. If you come to the end of an accounting period, you might have earned some interest. Now, you're not going to get cash on that day, but you have to show the amount of interest that is earned at the end of that period. Okay? So the AJE would be done like this example. On December 1 of 2007, Matrix Inc. purchased a copier for $12,000 from Office Supplies. Matrix issued a 9% note due in 90 days in payment for the copier. What adjusting journal entry is required on December 31, the end of the company's accounting period? Now, how many days have gone by since we made that note? How many days? 30, okay? So, the amount of interest that we need to accrue is the principal of $12,000 times the annual interest rate of 9% times 30 divided by 360. That's $90. Thus, our AJE, this is an AJE a la Chapter 3, where we debit our receivable and our interest receivable more specifically, and we credit interest revenue. Okay? Questions on that? All right. Now, there is something also called disposing of receivables. Sometimes companies need money right away, and they want to convert them to cash quickly, even before they're due. So what they can do is they can sell, or sometimes it's called factoring receivables, okay? Coming off that, let's say that Peter owed me $1,000, okay? Peter owed me $1,000, and it's not due for another 3 months. But I need money today. I need money today. So what I might do with Brett is have an arrangement where you give me $900 right now, today, so that I have my cash, and I need my cash today, even if it's a little less, because I can't wait 2 months. And then in 2 months, you get to collect the $1,000. You see what I'm saying? You made your money by giving me $900 today, and in 2 months, you get to collect $900 plus $100, $1,000 from Peter. Does that make sense? So I take less money, but I want it today. Okay? Is that basically, you ever seen payday loan places? Those aren't businesses you want to get in the habit of going to. Because what they will do is they're like, if you need money right now, Brian, and you know you have a paycheck coming of $600 here in a week and a half, they might say, well, we care about you so much. Well, we'll give you your money now, or we'll give you some of that. We'll give you $530 now, and then they collect the $600. Okay? And it doesn't, I'm not a big fan of those types of businesses, because if you figure out the annual interest rate, if you figure out an annual cost of what those people are paying to get their money a little early, it is expensive. Okay? It is unbelievably, it may not seem like much. Oh, all I'm doing is paying $50, but I'm getting it a whole week earlier. Well, you paid $50 for getting it 1 week earlier. If you figured up the interest rate, the annual interest rate, which is how people usually analyze interest rates, it would be a staggering amount. Okay? All right? So if anybody's watching this on TV who owns a payday loan place, they probably don't want me to say this, but try not to frequent them. Okay? Try to plan your money out better so that you don't have to pay such exorbitant interest rates. Okay? But there are factoring situations where it is not that excessive. Okay? Make sense? The other thing that this slide says that we can do is we can pledge receivables as securities for a loan. Okay? Now, you know that when you get a loan, you have to have some collateral. You have to put up an asset, right? If you get a car loan, usually your car is actually the asset that is collateral for that loan, right? Now, a receivable, if it's a true receivable, one that's going to be honored, that is an asset that we can pledge as collateral for a loan, just like an automobile. In fact, in many situations, which do you think a bank would rather have? A good, honest receivable of $10,000 or repossess your car, which was $10,000? They would rather have the receivable. They want what's ever closest to cash, okay? One thing you'll learn about banks, banks don't want your home that they loan you money on. They don't want your car, okay? Now, last resort, they'll come take those assets, but they don't want that stuff. They want cash, okay? They want cash, okay? So in many instances, if you have a $10,000 receivable, you can pledge as collateral for that loan, which means that if you don't pay your loan, they get to go to that receivable and take that money. They would much rather have that than to go take your new Honda. Because then what are they going to do with the new Honda? Then what do they have to do?
They have to sell it.
They have to clean it up, they got to sell it, all that sort of stuff. And they're not really, they don't want to be car dealers. They're bankers. Okay? Make sense? Okey-doke. All right. I think that is the end of our lecture because we've already been through the AR turnover. So, the homework that I'm going to give you, not a whole lot of it this time. I'm going to give you quick study. Well, let me write it down and then I'll put it up there. We will start chapter 10 next period. Now, before I put the homework up, as a refresher, we probably have 2 more lectures, okay? 2 more lectures, and it will be a lot of chapter 10 stuff. We'll refresh chapter 9 a little bit as well. And then we'll have our test. So our test is actually, our next test is actually over chapters 8, chapters 9, and part of chapter 10. Okay? Part of chapter 10. Chapter 10 is kind of long. And chapter 8 and 9 are actually kind of short. So I like to have some of 10 in that test. Now that will be the last regular test that we take. Then what we'll do after that test is we'll finish up 10, we'll do 11, and there'll be a comprehensive final exam over chapters 1 through 11. Now we don't, except for chapter 7, which we didn't go through. Now, just as we have a couple minutes, so on that final, don't freak out too much about that final. Sometimes students really freak out because it's like a comprehensive final, holy schmoly. This stuff builds on itself so much that you'll be surprised when you go through it, it will come back to you, hopefully, quicker than you realize. Okay? A lot of that stuff that we did in County 1 and County 2 we're using every day, right? Okay. Stuff like FIFO and LIFO, if you learned it right the first time, I guess I should assume. If you never learned it the first time, it's not going to magically come to you the second time. But so that's kind of our plan, all right? So we'll have 2 more lectures after this one, and then that will be the end of the material that will be on the next test. Make sense? All right. So the homework for next period is right here. Quick Study 9.5 and exercise 9.10. And we shall see you folks later.